on the breakout. Gold's going to make a new all-time highs.
Gold-backed ETFs in inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin. Hey, Shane Moran here, and welcome to Live from the Vault. I'll be your host, and what a volatile week and a half or so. We're back with Andrew Maguire from Talking Gold. And by the way, just before we go to Andrew in the UK, hit that like button, share this information with everyone you know. And if you hit the bell and hit that notification there, you'll be able to be notified as soon as these sessions and these editions go live. So I'm fired up. I'm excited. Lots going on. Make sure to buy physical, all right? Make sure to buy physical, and you know where to get it. So with that, let's go to the UK. Andy Maguire, how's it going? What is happening?
Hey, and what a volatile ride. And I think that's actually, you know, and welcome everybody. And nice to see you again, Shane. But I think that's it. That's the place to start. I think let's start by dissecting. I mean, this has been hugely volatile. If we can dissect this really, in fact, really, when you think about it, what happened that last week, Monday to Friday, was unprecedented. And then what we'll do is we'll look at that, and then we'll pick up the threads from last week's episode. But also, and this is really, really, I really feel what we're about to say here. I think it's time to put credit where credit is due. The Reddit group, the silverbugs, the silverbacks, the Wall Street channels within there. You know who you are, and I've just joined with you on this journey. And so what I'm saying here is, watch out, Comex. Do not underestimate the power of this physically driven short squeeze, and it's barely started. And you can't rinse these diamond hands out. These are wonderful stackers, and they're buying physical, not paper. That's close to my heart. And the paper market, really, if you think about it, has been the enabler of the house to historically win this game. But actually, it also, when you think about it, exposes their Achilles heel. Now, keep buying physical in any form or size you like, and dealers looking to fill your orders into a deeply undervalued, tight physical market will ultimately come after this Comex ill-gotten registered inventories. There is no physical available in size to fill your orders. Where do you think they will go? And we'll kind of look at that in a little while. But look, this is going to, bottom line, your actions are going to raise the offer price to sell bullion, or the Comex will be drained. Now, this is a first. And potentially, when we think about it, there's 10 million unshakable diamond hands potentially buying everything insiders dare to offer. That's the size of this Reddit army at this point. Okay, is it discoordinated? Is it coordinated? Hey, all I know is that when we start to look at things that are of value, then it's going to be taken up. Now, the action we're seeing is unprecedented. Now, while the Comex registered inventories purport to actually be there, they are leveraged. And the term is rehypothecated. It just simply means multiple ownership claims on a single product. And it's not, and not a single bad actor wants to sell you their bullion, whether it be gold or silver, at today's diluted prices. And let's look at silver a little deeper in a minute. But first, let's put this action into context, which is what Shane was asking. And obviously, we've got to have a wider view of what we experienced in the paper markets since last week's episode, which was only a week and a couple of days ago. Now, the gap up and gap down Comex-driven move commenced with the telegraphed Reddit-driven gap open last Monday. And if you remember, there was a lot of panic going on the previous Friday. And the silver Reddit guys were saying, we're coming in, we're going to attack silver, but not perhaps in the correct way, as we found out later. But as I say, the stackers certainly were, but there was that we'll look at the SLV and the buying in the SLV in a little while, but basically, this was still this last Monday. This what we call the Reddit gap. This was still largely paper driven though, and it was swallowed very, very swiftly by the official orchestrated Bank of International Settlements driven gap close, which was coordinated, if you remember, out of the blue, comes large house margin increases in silver and gold. I think it was 18% in silver and about 10, 11% in gold. And what had happened was by last weekend, it had inadvertently once more placed this past weekend so after we got through the Monday to Friday, it had inadvertently once more placed the Comex into an actionable catch-22 crosshairs for delivery in both gold and silver futures.
Yeah, awesome. Andrew, we just talked about this catch-22 phenomenon last episode and probably the episode before that too. Can you maybe catch everyone up on where we are now with this exact same catch-22?
Yeah, we did. We covered that catch-22 arbitrage trade and how it works. We did that in much more detail in, I think, the last two prior episodes. And we see this overshoot now as once more going to force discipline on how far the house can dare to dilute the futures gold price or silver price with undeliverable gold and silver contracts. Now, this is the arbitrage trade that we openly invited the sharks with the wherewithal to fully fund a Comex 5,000 ounce silver futures contract and a 100 ounce gold futures contract to enter the Comex, but to physically stand for delivery, forcing a game of who blinks first. Elon, come on in, our friend. You hate short sellers. This is a massive opportunity for a whale like you, and gold and silver will be the stable fellow traveler to complement your Bitcoin investments. And notably, in the last 24 hours, you're actually talking about adding the stable elements of silver and gold. Come on in. And given we know that Comex inventories have multiple ownership claims, even if they are cash settled. And obviously, when we're saying, come on in, we're talking about the whales here. We're not asking a stacker to go into the Comex and be part of the problem, because you're never going to be able to stand for delivery. This is inviting the sharks, the big guys, the guys who are actually also on Reddit, and the guys, the likes of Musk. And basically, what we're looking at is somebody that is actually going to be able to fully fund a number of contracts. You can own 1,500 silver contracts. You can own 6,000 gold contracts. But you can actually stand for delivery. Now, this is ultimately where I think this is going to lead. And so, and basically, because these Comex registered inventories, which are published, they look like they're there, but they have multiple ownership claims on them. Now, even if cash settled, as gold was, if you remember, we covered this, and it was breaking news at the time, and this was in November, it was cash settled for a $40 cash premium per ounce. Now, this is going to create losses for the house. They cannot endure for long. And last week, we actually evidenced April gold futures and March silver futures, which actually expire later this month, bleeding backwardations sufficient to attract the sharks one more. Now, this effect will increasingly force gold and silver to reflect a real physical price, which is something we have never, ever seen with the effect of the Comex to the over-the-counter dilutive position. And those news services that attempt to disparage Reddit traders, they're going to change their tune when it comes to squeezing physical gold and silver. Now, the mainstream news services, they scoff at the Silverback, Reddit forum, and they certainly were. In particular, all last week, Bloomberg, every channel I saw was saying, yeah, this silver squeeze, talking about silver, the silver squeeze, how it won't work. What they're doing, though, is erroneously likening it to the failed 1980 Hunt brothers attempt to break the Comex silver market.
Hey, Andrew, talking about the Hunt brothers, maybe I'm guessing here with the Reddit family, with the Reddit group all over from all the different groups that are on Reddit that are interested in this topic. Many of them weren't born when the Hunt brothers episode. Can you maybe give everyone just a brief description of basically what happened and what the result was?
Yeah, and really how this sudden, I must have heard it 20 times last week, you know, this mainstream media comparison of this Hunt brothers failure is farcical. And so really what it is the Hunt brothers had made the mistake of borrowing silver on margin from the house, and like any casino facing losses, they simply called in the debt and crashed the price of silver. So, I mean, it's a long story, but I've summed it up. That's basically what it is. Now, in this case, though, the short squeeze is being driven by fully paid up silver and gold demand. It's coming in from thousands of Reddit raptors swarming into the physical silver and gold space. Now, the key is to keep this onslaught up. It is absolutely critical that this onslaught continues. It may be announced here, it may be announced there. There's 10 million of you guys. It doesn't take much. And what it's going to do is drive the wholesale market price higher. It's as simple as that. No one is going to sell something into a tighter and tighter market unless the offer price will rise. So what I'm saying is, there is no need to blink when the house tries to shake you out. You are a physical holder. You are the benchmark. You are the anchor. Now, all this does is to give you actually a better price to squeeze the house further. Just like last week presented so many stacking opportunities. And I know I was monitoring some of what you were doing, and it really heartens me to see the pride taken by stackers. Together, we are the solution. In 45 years of precious metals trading and investing, I have never, ever seen such passion behind a trade. It isn't just a trade. It is actually a movement. Now, footprints last week, once again, evidence that it was a BIS sell-off. Bank of International Settlements is the central bank of all central banks. And they were concerned not so much about silver, they were focused on gold, which, of course, in the process, because it's one algorithmic machine, reluctantly, it dragged silver lower. Now, actually, that caused an issue because these algos work fine when the game is rigged as it's supposed to be. And I think we covered kind of that a little bit on that last time. And we did, I think we covered that in our last episode. Now, the veracity, though, of the gold future sell-off attempts are directly related to an official attempt to cover as much unallocated GLD stock, that is the gold ETF, as possible before June 28th deadline forces an extremely large unallocated, rehypothecated GLD position to be actually marked to market in physical form. Now, as we say, rehypothecation simply means that there's multiple ownerships claims on every single ounce held in the trust. Not very good if you're an owner of bullion in the trust. That's not very comforting. However, given the enormous physical buying that was ignited through this sell-off all across the UK, Europe, Switzerland, India, and Asia, into this blatantly obvious paper to physical price disconnect, which was caused by this management of the price, which then the algos all interconnect, overdid it in silver. And under the radar, and due to the lagging wholesale market effect, because obviously it is a lagging effect because paper is hot and it can be brought in huge amounts, and then it can be, then suddenly what it's done is essentially drive a price which can then be moved over from the Comex into the spot deliverable market, foreign exchange markets in London, and then bought, which would then be T+2, but it's normally T+2, 2 days to delivery. There is not enough physical to have a T+2 market in size. It is actually, it moves out to T plus whatever you think, it's depending on the size. Now this, certainly at current prices. Now this buying that we saw has not yet reflected the institutional central bank physical buying interest that was evident. And we're talking about central bank physical buying interest suddenly came in the wholesale market. And I'm telling you, the scale of which we have not evidenced since the March 2020 EFP blow up. And again, we've done so many, I think within the last 30 of our episodes, we have really concentrated on this March blow up in really big detail. And so obviously if there's any questions about it, please go back. But what is notable, this physical buying that came in this last week comes in at a stair step that is actually $350 higher in gold than it was it was $14.50 gold when the March blow up, EFP blow up happened. And we saw central bank size coming in the moment the 1800 spot gold was breached. And what that's done is suddenly tighten up supply. So at a minimum, based upon information aggregated through contacts at first and second tier dealing desks that we deal with all the time, at best estimate, there's currently around 12 tons of fully paid up gold client orders now targeting front month April futures contracts for physical deliveries. Now, Comex is not supposed to be a physical delivery market. It's supposed to be settled by a bunch of warrants being shuffled around and the bullion being moving across the blue center line of the warehouse from one side to the other, constituting a delivery. Not in this case. These are people looking for physical delivery. So after last Thursday, now if you remember, we shot up higher on the Monday and we shot back down and made some new lows on Thursday and Friday. And that was really about the BIS, the officials targeting a breach of the 1800 gold futures level. Now, what it did as a consequence, it triggered what we call plain vanilla backwardation to cash gold. So in other words, the futures price was actually cheaper than the cash gold price. So when accounting for, and this is a number we need to be aware of, when you account for the fact that this April contract in futures has a forward rate, and it is actually $2 for April delivery, what it did was actually trigger a perfect, actionable, arbitrable Comex backwardation, i.e. it triggered the cash 22 trade. And actually, given this week's follow-through backwardations into such tight physical supply, I think this becomes a bigger problem for the Comex, which is definitely under attack for the physical gold and silver it actually purports to have. So really what we're saying is, just like in March 2020, when central bank and sovereign buyers stepped in to the spot gold foreign exchange market, what they were doing was they're saying, no, we want delivery now. And their physical delivery demands were placed up on these leveraged, long, over-the-counter gold dealers who were hedged short on the Comex. A lovely paper-to-paper gold game, until someone says, no, actually, I think I'll take delivery. Why don't you just deliver it to me? And last week's breach of $1,800 in gold was clearly an unplanned overshoot. It triggered sufficient backwardations to potentially threaten another huge EFP blowup from a stair step, as we've just said, hundreds of dollars higher in gold, and certainly significantly higher in silver. And we'll look at silver in a little while. And I think one more thing we have to add is that, unlike March, these backwardations has additionally attracted the Reddit physical buyers. as well as incentivizing the Catch-22 sharks to buy April gold futures. Now, and the thing is, these Catch-22 physical buyers, the whales that we talked about, they can come in and stand for physical delivery because they don't have to be margined. They will pay for the contract up front. They cannot be rinsed because they'll be hedged. And what they can do is they will either take delivery or they will gain a cash premium not to take delivery. Now we can see, and we talked about this last time, and we can see that insiders quickly allowed gold back above 1800 to close that backwardation window as fast as they could. And in fact, they've driven the contango somewhere between $1 and $1.70, varying on the time of day. Really just enough to shut this arbitrage door, but too late to stop this hedge trade standing for delivery, and it will. Now, I think this is important to understand from a wholesale market perspective. Probably very few people realize what's involved with taking a physical contract out of the Comex. It actually only costs 50 cents per ounce to pay the house for Comex physical gold deliveries. Now, however, US entities do not have to pay the air freight friction that a European and a Swiss bank and the refineries require to offset delivery costs. So, you'd need at least $2 or maybe slightly over $2 to really cover those costs and make it worthwhile. But what this does, it makes it profitable for US traders to lock in the all-in profit price, even if it's backwardated by 80 cents to 90 cents per ounce. It actually makes Comex registered inventories very, very attractive and a no-brainer when the backwardations get anywhere closer to $2, which we saw. Now, right now, today, the house is protecting its registered inventories from further attack. But this is an actual razor-thin game. And the good thing for gold is that at last it forces some unwanted discipline on the insiders. Now, so since we drew attention in November to the Catch-22 arbitrage trade, forcing the house to pay $40 premiums for longs to not take delivery in November, officials are trying to be careful to avoid putting these rehypothecated Comex inventories back in the crosshairs. Now, this is related to 100 to 1 over-the-counter foreign exchange gold, and they're worried about this coming into the crosshairs for delivery. However, this psychological operations that the BIS attempt to inflict by inflicting volatility, inflicting negative signs into a sell-off that comes out of the blue and really just drive people out. These sell triggers, what they did was actually, in a sense, improved the market, because what they did is ignited a momentum spec driven washout. Now, obviously you need something to cover into. If you're going to rig the price lower, you need to know that there's something to cover that on that side. And so obviously on that Monday, to explain on this Monday where we saw the spike higher, the Reddit driven spike higher, and all the way into the Thursday low, what had happened was a lot of speculators had come in. And they were easy to rinse out. As I say, all they did was raise the margins by 18%. People were leveraged. They saw the price coming down. They thought, oh, I'm not having any part of this. And this is in the paper market. Not like the stackers, who were just simply saying, well, okay, I'll average some more in there. Great, this is a better price. I see silver at least $50, so why would I not take some more? So what happened was, I think this dip had clearly overshot house comfort levels. And while we can see that the Comex driven price rigging did assist, probably in squaring around 30 tons of these GLD unallocated positions, this is important because spot gold was in such strong demand in Europe, the UK, India, Asia. What it did was unwittingly drove April gold futures right into the shark's jaw.
Hey, Andy, I know that you have we spoke earlier, you've got some breaking news for all of our guests and all our community. Just before we get to that, where does that leave us now with what's happening? Maybe talk a little bit about the short term and maybe even the medium term right now, like what's happening?
Yeah, great question, Shane, and as also reflected by some of the questions that seem to have come from the group. So, and we're going to address more of these questions in the future. But look, I think really what we're saying is people are looking at it and seeing, hey, if the central bank of all central banks is like the Bank of International Settlements is able to keep rigging the price, how's this game ever going to stop? But the point is, if the BIS remains too aggressive in its efforts to unwind these unallocated gold loans and swaps, because that's all it is, loans and swaps, this is paper, the premium to cash settle could actually then escalate, because we've just talked about how this will be capitalized on in the paper market. Now this should contain the Bank of International Settlements efforts to oversupply unallocated gold to the agent banks privileged to have gold accounts with the Bank of England. And although these too big to fail banks are really, we talked about this last time, they're insulated from losses and they can ultimately be squared with a keystroke by the central bankers. But due to the migration of paper to physical and the realization the only immediately deliverable supply resides at the Comex price anchor is rapidly being dislodged. And it's being dislodged by who we're just talking about, the stackers. Now there's a massive shortage. You know this if you try and buy gold and silver. There's a massive shortage of gold and silver bullion for immediate delivery. And what is available is commanding very large refiner premiums. Now also, given that the BIS efforts require an equal volume of speculative open interest to cover into, which is what we just covered, and with the specs already psyched out and wrong-footed short or rinsed, there's very little to be gained by inviting a deeper sell-off. And this will simply increase the spot-related physical demand, which in turn then pushes the front-month gold futures deeper into backwardation, further risking another EFP blow-up hundreds of dollars higher than in March. And I think this is the catch-22 predicament the House has got itself into. And it is the first time in 50 years of Comex control of the Comex that a price-setting mechanism from the Comex has actually come under attack. So sharks targeting the Comex registered inventories are not the only risk for the House. We're certain that central banks and sovereigns are busy bolstering their balance sheets ahead of Basel III gold revaluations, which is going to be valued as a first-year asset. And it's prudent for all the BRICS countries, that is the Brazil, Russia, India, and China, the powerhouses. These are the gold people. These are the people that value gold. And these countries are looking to secure as much physical gold as is possible into a rapidly debasing US dollar, as gold prices estimated by all the first-year banks are at an absolute minimum of 2,500 bucks. Now what Reuters 2 weeks ago, I think it was, reported a multi-year drive to reduce exposure to the US assets has pushed the share of gold in Russia. They had to 583 billion or 185 billion. And basically what this has done is push their share of their international reserves above the reserves held in the dollar. This is the first time on record. So they're more bullion than dollars. Gold is now the second biggest component of the Russian central bank's reserve, other than the euro, basically. Now, this BIS move to unwind likely $1 trillion of unallocated gold derivatives ahead of Basel III isn't going unnoticed at all, with reliable information from last week from our Russian bank contacts that Russia's central bank once again stepped in to capitalize on the BIS defensive monkey hammer play. Let's just call it what it is, a monkey hammer to hammer the price of gold down. That's what we witnessed last week in their defensive action. And a central bank comes in, the Russian central bank comes in and buys. Now, I'm not saying that every other central bank came in, but I'm sure as heck, I'm sure that China wasn't sitting on the sidelines either. Every single wholesaler, bullion dealing desk and central bank knows that the Bank of International Settlements is focused on exiting unallocated gold liabilities before June 28th. Now, this raised awareness presents a huge opportunity for the BRICS central banks to bolster reserves at the Western central bank's expense. There's no love lost here. This will make it very difficult for the BIS to price rig paper gold too deeply, as it will become a major factor in triggering this March-like EFP blowup. So in summary, really, the divergence between the paper and the physical gold and silver market is threatening this kind of a blowup that we just saw in March, and from hundreds of dollars higher. And of course, we've got this looming Basel III deadline going into force. I mean, billions of ounces of gold and silver have to be closed or squared. And as we warned, as we entered February trading, although this is an unprecedentedly bullish for gold and silver time, and as gold and silver exits the paper game, we have to expect volatility. Look at the charts, you will see it. Volatility is coming through every day. And we've got to expect it because it's really gold and silver are components of a 15 trillion a year foreign exchange market. Look, if you add in derivatives, it's 5 times bigger than that. It's a staggering at least $75 trillion market if you weigh in the derivatives. But those derivatives are anchored on a physical price. And if that physical price gets too far dislodged from paper, the whole thing implodes. This is what you're doing. You guys are actually being a part of the solution. So gold and silver are still in the very, very early stages of this Basel III deleveraging mandate. So we would anticipate this heightened volatility as this unallocated BIS contracts are squared. Now, in plain vanilla form, as we just outlined, this volatility emanates from one side of the ledger when an unallocated long gold, short dollar foreign exchange gold contracts are squared off or closed. Because what that does, if you think about it, is it's a pairs trade. This involves selling. If you're going to close that unallocated gold position, you have to sell that gold long. And what's the other side of that trade? Buying dollars. And when timed with coordinated price smashes, which we saw last week, it's been very effective in creating unnecessary volatility, which is a tool in itself to disincentivize gold investments. Now, this explains the action since the beginning of January. However, we think actually now this has been overdone. And so basically what we're going to see, as we explained last time, there is another side to this trade. Yes, when you unwind an allocated position, but as more investors holding these unallocated gold contracts say, hey, I don't need this counterparty risk, let's convert them and take delivery in allocated form, it forces the banks to source some minimum of 99 ounces of physical gold for every 100 ounce demanded, probably 500 ounces of silver. And as we evidenced in March 2020, bullion banks holding long gold unallocated positions can and were and will be targeted for delivery of these contracts. And that's what blew up this paper to physical exchange for physical conduit in March. So it is this concoction of attempts to unwind unallocated gold and silver contracts that is driving this short-term volatility. But ultimately, this is extremely bullish.
Hey, Andy, can you just maybe touch on, while we're here, talk about the wholesale market and how this affects the wholesale market?
Yeah, as we progress closer to, let's call it D-Day, the wholesale market will increasingly determine the real price of gold for immediate delivery. I'm not talking about down the road in a futures price. We're talking about, you want gold, you want bullion today. What is the price? This is simply going to be the price a real buyer and a seller of owned immediately deliverable bullion is prepared to transact at. So why am I going to offer something when I think the price is going to be higher, unless I'm absolutely bound to sell it for a reason, for some reason, maybe a producer that simply has to simply bring something to market. But other than that, why would I? And there's really, when you think about it, the LBMA market, the PM fix, what are you talking about? 3 to 5 tons out of the hundreds of tons cleared in paper market form. So you're not talking about a lot of physical gold cleared in London. You're taking a hell of a lot more physical gold cleared bilaterally and off the grid. But essentially, what we're saying is the volatility encountered through the unwind process, as this occurs, when unallocated gold is marked to market to square up a position, at a minimum, it requires buying this 99 ounces of physical gold to square up a 100-ounce unallocated position. And the resulting price that gold will be offered for sale, it's going to be magnitudes higher. I don't even want to guess that price, other than a minimum of 2,500 is pretty much what the first-tier banks are talking about. But so between now and the end of the second quarter, and I'm giving really a wholesale view, we should expect, obviously, this additional volatility as these unallocated contracts get closed, as these bad actors race to exit. However, countering this effect of closing these unallocated positions, there are thousands of tons of spot index, which is the long spot gold foreign exchange position, which are locked into a price that can and will be demanded for delivery, plus an even larger premium of a spot, which will drive the deliverable spot gold price higher. And it's the spot gold price that is the physical price, that's closer to the physical price, even though it has to be bilaterally settled, it's closer to that price. And it will force the Comex either to go into backwardation or to raise its offer. Now, so in summary, this defensive BIS action that commenced on January the 6th, look at any chart, you'll see it so clear, has evidenced a series of consecutive fixed painting exercises. However, when you look at the footprints through a wholesale market lens, these fixed painting efforts point directly to Basel III preparations. And that's an attempt by the BIS to unload as many unallocated contracts as possible, which are undoubtedly directly related to large, and this is the key here, rehypothecated GLD holdings, which must be marked to market on a deadline of June the 28th. Now, this is presented a once in a lifetime opportunity for traders and stackers alike to load up on physical gold and silver at such discounted prices. And this is ultimately unprecedentedly bullish for gold and silver, as the predatory house accounts seek to load up physical ahead of an anticipated 20% gold price rise at a minimum into the end of June. That is an equation. There is the timeline for this. This cannot be changed. And this will likely be the revaluation point, and the ongoing gold will have to be priced in physical terms. Then what you could say is, how will this price reset unfold, do you think?
Hey, Andy, sounds like we're talking about a reset here. Maybe you can talk about how this will unfold.
So while these unallocated swaps and leases, which are, bear in mind that these swaps and leases are further leveraged by the too big to fail market making insiders, and while they can square them with a keystroke ahead of a gold price reset between now and the second quarter, GLD will be a major headache, as the GLD positions have to be allocated to pass an audit ahead of Basel III standards. And that's going to be enforced on all bank and ETF gold positions. And the attempts to force a large exit of GLD holders will fail into bullish gold conditions. That has been the objective. That's why you're seeing these smacks, these smackdowns. That's why you're seeing a fixed price being gained on a regular basis recently. And you see suddenly that on a bullish day, bang, down it goes ahead of the fix. Why? Because they're trying to fix a price, a spot price, which is how GLD is priced, and try and unwind some positions. And we figure they probably covered some 30 tons. That's tiny in comparison to the amount of physical that is supposed to be in, in physical form in the GLD. So this leaves little options other than to allow really gold to rise to a much better and stronger physical demand conditions that it really is running into. And if they do not allow the Comex market price to better mirror the cash physical market, Comex registered inventories will be forced into this actionable backwardation and targeted for delivery. We're seeing this. This is the Comex Achilles heel, and you guys are all over it. And so given the disparity between a diluted paper gold and silver price and real supply demand fundamentals, a gold price reset is absolutely necessary. And it'll almost certainly be conducted over a weekend. Now, we've looked at this before, and this is exactly how it'll roll out. It has to roll out this way. And what'll happen is it'll look like an ordinary close. That'll be a benchmarking of a cash settlement price for foreign exchange, over-the-counter, derivative positions in one stroke. And it'll happen. There'll be a price on a Friday market close. Then there will be a reset. Following this, gold and silver will open up on the following Monday morning, bid only. There will be no seller at this point. At a minimum, very little will be actually off for sale below 2,500 price that every first-year bank is already telegraphing. And the very reason they're all going long physical for their own book. And the 5 bullion bank insiders privileged to have gold bank accounts with the Bank of England, they're already going to be long both physical and foreign exchange gold ahead of the reset. Of course, they're going to be inside. And as a ratio, and this is at a ratio that will swamp any short hedges they have on the Comex. So, and we've already talked in the past about there's so many rules that have come into play over the last few years where the Comex during a live session can be halted for 5 minutes, and US traders are forbidden from trading the over-the-counter markets, the foreign exchange markets, the larger 75 trillion market that involves derivatives. But the same actors who are market making on the Comex can freely trade for the 5 minutes that the Comex is frozen. Now, obviously, we talked about that before and the inequality of that, and the options market can be frozen for 3 minutes while they can continue to trade. So I think that's not how it's going to happen. It's too obvious. It will happen over a weekend. It has to. And this is undoubtedly coming. And pullbacks between now and D-Day will be shallow and viable. Now, Reddit Raptors are greatly going to assist in this historic process. And look, this is history in the making. And silver will rise exponentially, easily exceeding $50, maybe $100, but it easily exceeding its prior highs, with insiders long physical and spot silver positions already, and they're ready for this. So very short term, between now and the end of the second quarter, which is the June 28th deadline, we should expect and anticipate additional volatility, but look to it as an opportunity, because these unallocated contracts have to get closed as these bad actors race to exit. But, there are thousands of tons, as we said, of long spot gold position wanting to lock in a price and at ever larger premiums over spot. And that's going to drive the deliverable spot price higher, which is going to drive the Comex price higher. So that's pretty much what we're seeing.
All right, Andy, let's now talk about one of my favorite topics, of course, is silver. What's happening with silver, and how can we get the inform the Reddit Raptors in terms, and of course, when I talk about silver, I'm talking physical. I never talk about paper or pretend or what if, physical, but maybe we could talk a little bit about this market.
Yeah, Shane, I know it's your baby. And in all the years I've known you, your eyes light up every time we talk about silver. And I agree with you. Look, I think what's important is sometimes we look for the little things. And silver is a much smaller market. Same actors as in gold, a smaller market, easier to read. So really, if we start by just drilling down into the silver footprints, it was really notable that unlike gold, last week's orchestrated spec cleanout failed to close the gap. And when I say the gap, I'm talking about the gap when on Thursday, ahead of the Monday ramp higher, somebody came in very large and that gap was never closed. Now this was suspicious in the sense that it strongly suggests someone very large, front ran the first Reddit driven spike and defended this long position into a very heavy, let's face it, the gold futures rinse was extreme. So as we say, go look at any chart, look at the Thursday spike, it was never closed. Look at gold, it was closed, more than closed. Somebody is, as I say, look, from a wholesale market perspective, somebody was defending that position. Somebody front ran that. And that is the level where I don't think we'll ever see it breached because there's a whale in there. And we've previously said, whether it's friend or foe, we don't know. That we can't say, but definitely the footprints say it was defended. Now, we've previously identified a level in silver that needed to hold. And the level we said was 26,225. This is a really important Fibonacci retracement level. It held. And this tells us that silver really should now be refreshed for a sustainable, physically driven catch-up rally into at least the 30s initially. Now, as discussed into the counterintuitive sell-off last week, and we didn't even cover most of it because we came in early, silver's physical buying is off the scale globally. That also puts Comex silver into the crosshairs for delivery this month in very large size. Now, the paper to physical disconnect is unprecedented and is closer actually in structure to June 2010, when we saw a physical shortage, a similar physical shortage. That was just before silver rose $32 higher from 17,325 to the 49,820 level. So this is not been seen since that time. This is an unprecedented situation. Bearing in mind, there's currently a large risk-free arbitrage opportunity, which we can confirm is being definitely capitalized on by dealers who are accepting and locking in clients' orders for silver at extremely large premiums. So when you go to buy your coins, or when you buy your small bars or your kilo bars, or even 100-ounce bars, or whatever it may be, that order is being taken by a dealer. Now, they're having to fill that order. And there's a large premium involved, and we can guarantee that no Comex insider wants to sell any of their ill-gotten physical silver inventories from the Comex at current paper prices. But it doesn't mean to say they won't be attacked. Now, given these massive orders and the cost to take delivery of loco New York Comex warehouse silver, now if you include the road freight to virtually any US location, is still less than $1 an ounce, and that the downside rinse only dislodge fresh speculators, not physical buyers, but further serve to increase physical demand because the price went down, with customers happy to pay large premiums up front. Now we see the Comex silver being targeted for delivery. It's the perfect target. And as we pointed out, this bullish condition has not been really seen since June 2010, when we saw the kind of price ramp. Just to give you an idea of scale of the price ramp, because of that tight physical condition, ultimately weighing on the shorts now in the Comex. Now, in fact, although silver has been in the news as being short of supply for delivery, don't forget gold has also been in very strong demand, with smaller bars commanding large premiums too, and delays. And this condition is also similar to June 2010. And that was shortly after gold rose $760. June 2010, 1155, and it went up to, if you remember, 1923 or 1925 or whatever it was, alongside really a concurrent silver short squeeze. So these will operate in tandem. I think silver will outperform gold though, in percentage terms. Now,
Andy, talking about silver, and I want to maybe talk to our Reddit Raptors. I love that name, Reddit Raptors, for all the Reddit people that are looking at the silver market. Maybe talk a little bit about, we talked about silver, physical silver, what's potentially about to happen, but what about SLV? Maybe you can talk a little bit about what's happening with SLV.
Oh, I love that picture of the Reddit Raptors swarming all over, swarming in every direction at the kill, which is the Comex, which is the ultimate kill. But yeah, looking at SLV, in all seriousness, we have expressed major concerns about this ETF, but it comes from the impossibility that thousands of tons could possibly enter and leave this ETF in physical form. Why? Because the physical market, from a wholesale market perspective, it just simply doesn't exist. Now, yes, everyone says, oh, there's plenty of wholesale bars in the market. Sorry, they're not for sale. And not in size, and you're very, very much limited. And we're waiting weeks and months for supply from the refiners, simply because everyone wants the same thing. And we're being rationed. Now, it's important to remember, the on and off ramps for SLV are in the form of unallocated silver. Same for GLD, but given the wholesale market is starved for bullion, with orders for even 1 ton stretching out to weeks and months, supply is rationed. Now, it's just impossible. It's just, we're basing it on the impossibility that these bars these bar lists 100% represent physical gold or in the trust. The last independent SLV audit was completed all the way back in March 2020. Yes, all the bars were physically accounted for, but 2 red flags popped up right away. And by the way, there's a hell of a lot of moves since March 2020, but 2 red flags popped up. First red flag is, okay, rehypothecation, double ownership. The ability to borrow and short sell these bars is not accounted for, yet it is allowed. And so really, what is the use of to come in and say, yeah, independently, all these bars are there, if they actually have more than one claim on them? Because that does not mean that if you've bought SLV and you're entitled to X number of ounces or tons of SLV, that you can have that, because many people may own the same product. Now, so since the second thing, since March, there's been a $19 odd price increase in silver and a $630 price rise in gold. At the time, the market was starved for physical supply. If you remember, they were on complete lockdown. The refiners had literally, because of COVID, ceased to operate. We had the EFP blow up. I mean, really, what we're saying is it's impossible when there was no physical moving, and yet we saw all these volumes coming in to both GLD and SLV. So I think likely the modus operandi is to use bullion bank in-house inventory that could be such as represented by JP Morgan Silver or other market makers. And what they would do is then lease this into the trust to gloss over shortfalls. So who owns this? This is the question. The bars may be there, but who owns them? Now, insiders rely on making it difficult to withdraw bullion from the trust. So that's really difficult for you to even take it out. Plus, as we discussed last time, because the on and off ramps are in the form of unallocated bullion, what a lovely smoke and mirrors entry exit. You've got a flywheel there where you can hide a lot of sins. And then when you take, if you were to take delivery, you then have to, you receive it in an unallocated bullion form. Then you have to go and bilaterally find someone to, you have to settle at a premium that you can find someone to sell it to you at, which is not going to be the SLV price. So it really is not a good instrument. So I would really like to close by saying, Reddit stackers, you are doing an amazing job. But, you know, but if it would be of value though, now I would really say I'd like to be happy to offer my help in answering some of your questions that you have. And look, we're all part of the solution here. I'm really buzzed by what you guys are doing. I will ask the team to set up some sort of Ask the Expert session, perhaps, so that we can better assist you on this journey. So we're going to do that. And thank you for what you are doing.
There you have it, everyone. You just heard it live. Mr. Andrew Maguire becoming a Reddit Raptor. That's awesome. It's exciting, and I'm fired up. I'm excited about this. And if you are having questions or whatever, just make sure you comment below. The team looks at every question, and let's get some questions out there for Andrew directly from the Reddit Raptors. Awesome stuff. Thank you so much. Hit the like button, share this with people you know, like, and trust, and we will see you next time on Live from the Vault. Bye for now.